My name is Rob Fredericks. I'm the Executive Director of the Housing Authority of the City of Santa Barbara, and I'll be your moderator for this session. And this is the Affordable and Workforce Affordable Ownership Housing Workshop. And joining us today via Zoom are two professionals in this field. We have first Andrew Kish. Andrew is the Inclusionary Housing Program Specialist for the County of Santa Barbara's Housing and Community Development Division. As a UCSB graduate and real estate broker, Andrew has a background in mortgage lending, property management, and consumer advocacy. Also joining us is Maria Schroeder. Maria's with the city, and she's been a housing program specialist with them since early 2020. She oversees the city's portfolio of 445 owner-occupied units and works with clients in the affordable homeownership program. Before her starting with the role with the city, Maria worked for many years as in the private sector as a mortgage loan originator, both in California and in Texas. She attended a great school, Cal Poly San Luis Obispo, Go Mustangs, where she earned her bachelor's degree in business administration. After living in several places, San Luis Obispo County, Orange County, Los Angeles, and Dallas Fort Worth, Maria returned to her quaint hometown of San Ynez. When she isn't working, she enjoys hiking, practicing yoga, traveling, and she's excited to share the city's program of affordable home ownership with you today, and welcomes you to the Housing Santa Barbara Day.
Hello. Thank you, Rob, for that introduction. And so, yes, like Rob said, I am with the City of Santa Barbara. I'm in the Community Development Department, and I'm a housing program specialist, specifically monitoring the Affordable Housing Ownership Program. So I'm the person you would contact to get on the interest list. I'll talk about that later. And you can pick up a copy to fill out at the city's booth, which is booth 10. And when you go by there, say hi to the rental housing mediation team who's sitting out there. You can always go online for that form. So one of my biggest passions is discussing home ownership. I feel like it gives someone more security in their financial future and gives someone the feeling of stability. As a renter, you never know when your landlord is going to increase the rent when your contract is up. And as a homeowner, you have a mortgage with set monthly payments. So it's easier to kind of set your budget. So you kind of know what to expect when you have a mortgage, and you're able to refinance here and there. So yes, as a homeowner, you need to save for maintenance and unexpected repairs. And as a renter, you just contact your landlord and they'll do that for you. So, but overall, I'm a big advocate for home ownership, and I love discussing how you can become one. I'm going to start my presentation with, I'm going to share my, there we go. So I'm sharing my screen. Hopefully you can see it. Can you see that? I can see everyone. Can you nod? Okay, I see thumbs up in the back from Rob. Okay, so I'm going to start with an overview. I'm going to talk about the Affordable Ownership Program first off, and then I'm going to outline eligibility requirements. And you can look at these eligibility requirements online. We have a form that lists all the eligibility requirements. And then I'm going to talk about the process of being selected to purchase, what that looks like. I'll talk a little bit about the covenant, and that's a very important document that gets recorded against the property. The City of Santa Barbara's covenant is 90 years. We do have old covenants that were for 30 years, 45 years, or 60 years. And some of those are starting to fall off. The property then goes to market value, and the owner can sell at market value. So some of the homes, the covenant is expiring and our inventory, so to speak, is declining. I'm going to give you a few recommendations at the end of my chat, and then I'll show you contact information for myself and my coworker, Melissa Bonillo, and then I'll answer questions. So first off, what is the Affordable Home Ownership Program? Let's define affordable. Well, in the city's eyes and most of the affordable ownership programs, that means 40% of a household's gross income towards housing. So that is principal, interest, property taxes, hazard insurance, and HOA. A lender might refer to it as PITI. So if you hear that, that means principal, interest, tax, and insurance. So that is the housing expense. So things like utilities, we wouldn't include in that ratio. So the home ownership program that the city oversees, we have 444 units. Yes, we just lost one. The covenant came off recently. So we have 444 units, and that includes our workforce housing, which I'll talk about in a moment. The way that it's broken down, you can see the numbers. We have 25 in the low income category. We have 261 in the moderate income category, 103 in the middle, 18 in the upper, and then price restricted, we have 37 units. And that'll make more sense as I go on with my discussion. Workforce housing, what is that? So Cottage Hospital has their own program. If you work for a Cottage Hospital and you're a full-time employee, and it's also includes the affiliates of the Cottage Health System. And if you work for them, I would suggest going to the benefits department and asking if you would be eligible to be on their wait list. So that's different than the city. Ours is an interest list. Cottage Hospital has a wait list. And we partnered up with Cottage Hospital. The city oversees their units that they have. Westmont College, same thing. If you work for Westmont College, they have a wait list for their units, for their affordable units. You might wonder, where are the affordable units in the city of Santa Barbara? Well, if you go on to the city of Santa Barbara's website, we have a map. And you can see the map here on this slide. You want to concentrate on all the blue dots that have an O for ownership. If you go on to the Santa Barbara website, there is at the top of the page, it'll say services, and then there's a drop-down menu. You click on housing and human services, then click on affordable housing. On the left side of the screen, it'll say affordable housing map. Click on that and this screen will pop up. I also listed the URL that will take you right to the map. So how do I know if I'm eligible? First thing is, you must live or work in Santa Barbara. That means Gaviota to the Ventura County line and south of the Santa Ynez Mountain Ridge line. Household income, you want it to not exceed the income category for the selected unit. So let's say you're selected for a unit, you have 2 people in your household, and it's a moderate income unit. Then your current gross income cannot exceed $86,496. This chart is online. It's on the eligibility requirements, and it's also listed on the form that you would fill out for the interest list. continuing on how do I know if I'm eligible, you would want to know what your credit score is. We need a credit score of 620 or better. Well, how do you find out about your credit score? You can contact Experian, Equifax, TransUnion. If you go to a lender, they would tell you your credit score because they would pull your credit. And you want to know what your FICO score is. That's what the lender is going to look at, is a FICO score. Experian, Equifax, and TransUnion, many times they will give you a credit report yearly for free. But it's really important to find out what your credit score is. The next thing that you would want to know is, what is your debt to income ratio? What does that mean? So you're going to look at your gross income, and 40% of that can go towards your housing. If you have other expenses that would show up on a credit report, like credit cards or car payments, then 50% of that expense, or 50% of your gross household income, can go towards all of your debt, your expenses that show up on your credit report, and your housing debt. Within the last 2 years, we would not want you to be a current homeowner at the time of application or during ownership of the affordable unit. If you sold your home last year and within the last 2 years, we would allow for you to be eligible, but the caveat is that your net proceeds from the sale of that home cannot exceed 50% of the purchase price of the affordable home. So if you're buying an affordable property and it's $300,000 and you sold a home last year, then your net proceeds could not exceed $150,000. Next, we require 5% down, and it must not exceed 40% down. Moving on to more of how do I know if I'm eligible. Gift funds. We allow up to 20% of the purchase price. So this is where I say in my recommendations, you might want to talk to your family and see if they would gift you funds towards the purchase of your property. You see in parentheses here, I have 12 months review. So what that means is gift funds. Let's say you have a relative that gifts you money at Christmas and your birthday and other times throughout the year. The city is going to look at 12 months review to make sure that any money that you didn't earn and that you don't owe to someone would be a gift. The third option would be a gift fund, that it's not going to exceed 20% of that purchase price. I can clarify that for you later if need be. So all occupants of the property 18 years or older within the household are subject to eligibility requirements and must sign all loan paperwork, including the promissory note and the deed of trust. We allow you to have a co-signer for loan purposes, but you must qualify through the city's requirement without the co-signer's income. That co-signer can only be 1% owner of the property, and that would go on title, and they cannot occupy the property as their primary residence. So how would you be chosen for one of the affordable units? The main way is through resale. There's 444 owners right now, and let's say one of them decides to sell, and you know them through friends, and they come to you and they say, hey, I'm selling my affordable unit, and I'd like to pick you as the buyer. Well, first of all, you would have to look and see if you're eligible through a lot of the bullet points that I listed. And most importantly, you would have to make sure that your income does not exceed whatever type of unit they have. going back to that moderate income example that I gave earlier. The other way is that the seller asks the city for the interest list. We would provide that to the seller and they would choose someone off that interest list. That's why it'd be a good idea to get on the interest list if a seller decides to sell and ask for that interest list. Now, the second way to be chosen for one of the affordable units is through a lottery. The last time we had a lottery, it was for the estancia units that are on State Street. And right now, we don't have any current lotteries that are coming up in the city of Santa Barbara. And lotteries are held for newly constructed units. So the interest list, like I said before, the forms are at the City of Santa Barbara's table, or you can find them on the city website. And I want to clarify, it's not a waiting list. It's an interest list. So just to clarify that. This is the section that I'm going to talk about the covenant just briefly. So what are the requirements or restrictions of owning one of the city's affordable units? So the covenant is for 90 years. Yep, that may sound like a long time, but we want to keep the inventory of affordable units in our inventory. It restricts, the main thing it does, it restricts the value. The value is calculated off of area median income, also known as AMI. And the entity that sets that is the United States Department of Housing and Urban Development, more commonly known as HUD. They release the figure, the AMI, yearly, usually in April. So I want to also clarify a point. You do gain equity. If you own one of the affordable units, you gain equity in two ways. You pay down your mortgage and the AMI, it generally increases. So those two ways, you would gain equity. And if you sold your affordable unit, you would get to keep that equity. So another requirement of owning one of the properties is that it must be owner occupied 10 out of 12 months. So if you're on an extended vacation, you would need to let the city know, and we would need to approve that. Let's say you're gone for 3 months. If you have something happen where you're in the hospital for 5 months, you just let the city know, and we have waivers that we would allow for situations like that. You need to notify the city of any financing or title changes. So if you're doing a refinance or a home equity line of credit, you need to let the city know. It's very important. We have documentation that goes along with that. We need to make sure that you are maintaining your compliance with the covenant. If you have title changes, you add a spouse or delete a spouse, or put the title into a trust, we allow a revocable trust. So it's good to let the city know that too. If you're renting the unit, it also requires the city's approval. Many times we allow for renting out your entire unit up to a year, but we calculate the maximum rental amount. Another thing is you cannot own other real estate. So if you inherit a property, then you need to decide if you want to sell your affordable unit or sell the inherited property. So those are just some of the items that are in the covenant. I like to share that with you so that you understand what the requirements would be there. So here's my recommendations. Choose a lender, get pre-qualified, then you know what you're working with. You've gone through the process of collecting your documentation. You understand the terms of PITI, DTI, LTV, and all those other terms. You get familiar with it. This also is helpful because then you can work on items that need to be addressed to put you in a better position to buy, like increasing your credit score, paying down debt, putting aside savings, and or asking a family if they would consider gifting money for a down payment. So sign up for other interest lists: the City of Carpinteria, the City of Goleta, the County of Santa Barbara. You might even want to look north and south, Ventura and San Luis Obispo, and see what interest lists they might have. You might have to live or work in Ventura or San Luis Obispo, but it's good to get on as many interest lists as possible to increase your odds. And you should look at reviewing the information in the Santa Barbara Affordable Housing Resource Guide. We have that online as well, and they do have some here today at the information booth. Some of those printed out. That's a great guide because there might be other situations, not with the city, not with the county. It might be through Habitat for Humanity or another nonprofit. So check out that resource guide. It has a lot of good information. And with that, here's how you can contact us. My name is Maria Schroeder. My phone number is 805-564-5461, extension 4476. My email address is mschroeder@santabarbaraca.gov. You can find me online as well. You go to the City of Santa Barbara. My contact information is there. My coworker, Melissa Bonillo, also oversees the program. Her phone number is 805-564-5461, extension 4585. And her email address is mbonillo@santabarbaraca.gov.
Okay. Well, thank you, Rob. Thank you, Maria. That was a lot of useful and valuable information. And thank you to Rob and Jerry for hosting this wonderful event. The whole goal and motive of the county participating is we want to encourage homeownership amongst the workforce. The importance of workforce housing is imperative to our community because we want to ensure that families and households have the opportunity to live and reside close to where they work. We don't want to create a commuter environment where people have to commute, maybe 2 to 3 hours each day to go back and forth to work, because that's a drain on their family time. And it would discourage employees from working for local employers. It's almost creating like a brain drain. So creating housing opportunities and educating interested applicants is our goal. So let me share my screen. We can go through some of these slides. Okay, and I think, can you guys see the screen right now? The homeownership screen? Wonderful. Okay, excellent. So workforce homeownership. Santa Barbara housing market in general is very competitive, I'm sure, as you guys are aware. And so it's not necessarily a matter of luck in order to accomplish homeownership. It's more along the lines of being prepared for the opportunity. And so what I'd like to do is educate you guys today on how to prepare yourselves for any purchase opportunity, whether it's through an inclusionary program such as the county's, whether it's through the city's program, through the City of Santa Barbara, or any other program in the South Coast, which also would include, like Maria mentioned, City of Goleta, City of Carpinteria, City of Santa Barbara, et cetera. So what we'll do today is we'll go through some education, some financial literacy education. That seems to be the theme of this afternoon, because we do want to make sure that you guys are prepared for what could be the largest financial decision that you're making in your lives. So with that being said, I'll move on to slide 1 and discuss the benefits of homeownership. Some of these were covered, but ultimately the goal is to build wealth over time. You could build wealth over time in a couple of different ways. Like we mentioned here, you could build equity each month, and you can do that by paying down a mortgage that you have, and then also by benefiting from the overall appreciation of the value of your property. Recently, appreciation has been kind of through the roof due to the lack of inventory and the high demand. But generally, on a national level, you could probably expect to see anywhere between 4 to 5% worth of appreciation on a home on an annual basis. But again, locally, it's probably been closer to double digits for the last few years. But that may have to do with, again, the inventory being lacking, and then also the demand being high, because now a lot of people are able to qualify now that interest rates are low. So we want to make sure that you guys can, again, take advantage of opportunities once they arise. Another benefit of homeownership is income tax deduction. You have the ability to write off against your active income. You can write off the interest that you're paying toward the mortgage. You can write off the property taxes that you're paying toward your mortgage. Private mortgage insurance you can write off as well. And we'll talk about that in a moment. So there's definitely benefits as far as tax deductions are concerned. A forced savings plan, it's a non-liquid asset that you have once you purchase a home. So it's not like you can tap into it like a general checking or savings, but that equity that you build over time, that's almost like it's a forced account that you don't have access to. So it's almost automated, which is nice. A capital gains exclusion, once you do sell the property, if you, as an individual, if you profit up to $250,000 as an individual from the sale of your property, then you're not having to pay you don't have to pay capital gains tax on that increase in value. If you're a married couple, you don't have to pay capital gains tax on up to $500,000 worth of profit from the property that you sell. So there's a capital gains exclusion. And I think Maria mentioned this too, that buying eventually is going to provide stability, because you're not going to have the fluctuations of your rent from a landlord who's going to continually increase your rent over time. And eventually you'll see that purchasing a home is going to be cheaper than renting, because eventually you're going to pay off that mortgage, whether it's in 30 years, whether it's in 20 years or 15 years, depending on how aggressively you choose to pay down those monthly payments. Eventually you will reduce that expense from your budget because you'll own the home outright. So eventually it's going to be, it does pay off in the long run. Okay, moving on. I like this slide because it mentions a lot of the different components of the purchase process. But as you can see on the bottom left, the cornerstone is going to be that mortgage. And so in order to even put yourself in the running for any type of opportunity that presents itself, you need to have the mortgage squared away. And you can communicate with a local lender, whether it's a credit union, whether it's an institutional bank where you have your checking and savings account. You want to have your numbers put together. You want to make sure you understand how much you can afford to purchase. You want to make sure that you're comfortable with that mortgage payment within your existing budget. So again, a mortgage is going to be fundamental as far as preparing yourself for these opportunities that arise. So that being said, mortgage qualification, there's a few different items that we want to stress, one of which is going to be the down payment. You want to make sure as a borrower, you're going to have at least 3% worth of 5% of the purchase price that you can put down as far as a down payment is concerned. That adds up. On average, these homes in Santa Barbara, I would say, roughly a fair market value home is probably costing about $500,000. And so a down payment of anywhere between 3 and 5%, that's going to be between $15,000 and $25,000. So you want to try and allocate your savings appropriately so you can use those funds and take advantage of leveraging in order to qualify for the best type of financing when you do apply for the mortgage. There's different opportunities that are available to workforce households in order to come up with that down payment. There's a local program with the Housing Trust Fund of the County of Santa Barbara. They offer some assistance that you might want to look into. There's also a statewide program through the California Housing Finance Association that could also offer down payment assistance programs, depending on the type of work that you do, depending on the income that you earn. So I did list later on in this slideshow, you'll see a link to those websites, but there are opportunities for borrowers to get access to funds that could be offered to them in the form of a grant or in the form of a silent second mortgage that could help them come up with that either 3 to 5% worth of down payment. But that will be required unless you have a certificate of eligibility as a veteran, then you can qualify for a VA loan for up to 100% of the value of the property. But generally expect to pay about 3 to 5% down for the down payment. In addition to the down payment, you're going to have to set aside about 3 to 5% worth of closing costs. Again, that's anywhere between $15,000 to $25,000 on a $500,000 property, which is average. That's just fair market value. The closing costs, there's a couple ways that they can be paid. You can either pay them out of pocket, or you could potentially finance them if you do have good enough credit. But just expect that that will be a factor when a lender determines what type of mortgage and how much of a mortgage you might be able to qualify for. Thirdly, credit score. Maria mentioned this, and I believe that the financial literacy workshop next door definitely stressed this as well. Your credit will determine whether or not you qualify for a loan, and it's going to also determine what type of interest rate you qualify for as well. Ideally, if you can have a credit score of anywhere above 620, then you'll be able to qualify for the more competitive financing. The scores range between 300 to 800. But the higher the score, the better interest rate that you have, because that's an indicator of your willingness and ability to repay the debts that you've already established relationships with. And your mortgage lender, they're going to want to establish a long-term relationship with you, potentially after 30 years, maybe even 40 years. And so they'd like to see that within the last 7 years worth of your credit history, what have you done to prove to them that you're a worthwhile risk? And that's why you want to be on time with all your payments. And we'll discuss the factors that go into the credit score, but that's imperative. You want to start working on that credit immediately if you haven't already, and getting that score as high as it can be. If you can get it, above 760, then you're in really good shape. Then you can be eligible for what they call A-paper loans. And so it's going to give you the best type of financing and the best types of interest rates. Maria mentioned debt to income ratio as well. This is a maximum of 45%. Ideally, it depends on the lender, but what that means is that debt to income ratio is the total monthly mortgage payment plus all of the minimum monthly payments on your consumer debt that show up on your credit report. All that combined should consume no more than 45% of your monthly gross income. I'll break this down a little bit further into the slides, but again, this is your gross income. So if you think about it, if 45% of your gross income is going toward your mortgage payment and all your debts, it's a higher percentage of your take-home pay. And so, I know nowadays a lot of people are spending up to 50% of their income, if not more, on even rent or even mortgages. But as far as a lender is concerned, if you start getting close to that 45% or higher, it's riskier. And so they're not going to be as willing to offer that loan. So try and keep all of the debt obligations, including that new mortgage payment, try and keep that below 45% of your monthly gross income. Okay, saving for homeownership, cash to close. If you haven't created a budget already, I certainly suggest putting one together. You want to create a budget of your monthly expenses. And this might take a little bit of time, maybe 30 to 60 days, but identify what are all of the sources of income that you're receiving on a monthly basis, and then compare that to all of your monthly expenses: rent, utilities, transportation, groceries, education, et cetera. And so when you compare your monthly income to your total monthly expenses, you're going to come up with either a positive cash flow at the end of each month, once you deduct all of those expenses from the income, or you're going to have a negative cash flow. If you have a positive cash flow, then you're in good shape. And that means that you can allocate some of that positive cash flow, if not all of it, towards some type of a semi-liquid account so you can prepare for that down payment and prepare for those closing costs. If a lot of the times people experience that they're seeing a negative cash flow because their expenses on a monthly basis are exceeding their income, then that usually means they may be borrowing against credit cards. They're in the red. And so you want to identify that there's a negative, make some adjustments to your spending, and then go ahead and put yourself in that positive category. Because if you're in a negative cash flow, then you may not be in the best position to qualify for a mortgage or prepare for a home purchase, but you can make those changes. But take a look at that budget to really identify what the cash flow is, and then also realistically how much of a mortgage payment you can afford. Because a lender may qualify you for up to that 45% back end ratio, but you still need to be comfortable with what that mortgage payment will be when you plug it into your monthly budget. So that's definitely something to consider. You want to save for closing costs, like we talked about, 3 to 5%. There are those programs you could take advantage of through the Housing Trust Fund of the county and also through California Housing Finance Association. Create a budget to pay for supplemental property taxes. This is an extra expense of probably a couple $1,000s that you would be obligated to pay after everything is said and done. Once you move into your property, the value of the property that you're buying is different than the value of the property that the owner purchased their unit for. So that difference needs to be made up for with the county's property tax obligations. And so you will get a separate bill coming to you. It will not be paid out of closing costs. And so you have to be prepared for that extra bill to come for the supplemental property taxes. That's why having a budget with that surplus cash flow and some liquid savings is going to be good to help you prepare for that. Post-purchase reserve funds. Ideally, a lender is going to want to make sure that you have at least a couple months worth of what your mortgage payment would be set aside in something, an asset that you have, or even your checking and savings. Because if something was to happen, if you were to lose your job, or if you saw some, major medical expense that was unforeseen, a lender wants to see that you can have something to depend upon in the event of an emergency, so you can continue to pay that mortgage payment for at least a couple months to get you through that transition period. So make sure you have enough to have set aside for those reserve funds. And then, of course, repairs, renovation, maintenance, those types of things. You're going to want to make some adjustments to the house. You maybe want to scrape the ceilings. You want to, put some baseboards in. You might want to do a little bit of work to make it home. And so you want to prepare for those expenses when you do move in. Ways to develop your savings, you can automate it. If you do have a relationship with either a credit union or institutional lender, you can communicate with them and have them, if you have like an automatic deposit of your paycheck, for instance, you can have them set aside a certain percentage of that to have in an exclusive home purchase prep fund, if you will. And so you can have that automated so you don't necessarily see it in your checking account. So that's one way to take a look at it. Gifts. You can get gifts from family members or friends. The county's program, I think the city's as well, doesn't allow for gifts above and beyond 20% of the purchase price, but gifts are a good way to make up for that down payment in this highly competitive market. And then again, you can always use retirement accounts, specifically 401k, 403b, or IRA funds to go ahead and you can liquidate funds from either one of those investment vehicles without a penalty if it's for the purpose of a home purchase. So that's a good way, it's a good resource to use when you are preparing for the down payment. Okay, building credit. Like Maria mentioned, you can get the 3 credit reports from Equifax, Experian, and TransUnion. They act like libraries that record the information that is reported to them from all the different consumer relationships that you have with different creditors, whether it's your auto loan, your student loan, credit cards, store cards, what have you. You want to make sure that you take a look at these reports well in advance. There's oftentimes there's errors on these reports. And that error may be due to fraudulent activity. It may just be due to mistaken identity, but you don't want to be stuck waiting for those errors to get rectified if you're in the middle of a process of applying for a mortgage. Oftentimes it takes 60 to 90 days to improve or to make up or to correct those errors. And what could happen with interest rates over a period of 60 to 90 days? They could increase significantly. So you don't want to be held up by those inaccurate or outdated information on the report. So get these reports from Equifax, Experian, TransUnion at least 60 days before applying. Again, those scores, those credit scores, they range from 300 to 850. The higher the score, the better. The higher the score, the more risk worthy you are as far as your lenders are concerned. And then building your credit score. To improve the credit score, you want to make sure you're on time with the payments. There is portions of the credit report which identify how many times you've been late, whether how many times you've been 30 days late, 60 days late, 90 days late. If there's accounts that have gone into collections, you want to make sure you have those paid off, because you don't want to have that outstanding obligation when you're trying to apply. Obtain a secured credit card if necessary, pay down the balances. This website is the best way to get those credit reports. You can get those reports from all 3 bureaus from annualcreditreport.com once every 12 months for free. So you can get them online, or you can make a phone call to that phone number and get those reports mailed to you. But start there. Between budgeting and improving your savings, the credit is the next step as far as proving to a lender that you're worthwhile to go ahead and obtain that loan to get that mortgage. So get these credit reports well in advance. At least make sure there's no inaccuracies or outdated information, and make sure that when you are ready to apply, that there's nothing that's going to stand in your way. Okay, I like talking about credit, obviously. So these are the different score factors. Your credit score, like I said, ranges between 300 to 850. And these are the different, criteria that's used to determine that score. And as you can see, the 35% is composing the largest portion. This is your payment history. So this is every time that you've been 30 days late, 60 days late, 90 days late. You want to ideally, within the last 24 months or 2 years, not be late with anything. Don't have any outstanding collections. If you have had collections in the past, that's okay. Just make sure that those collections have been paid off. You can communicate with those collection agencies. You can settle for 50% worth of the outstanding debt. It just requires a little bit of negotiation. And so again, payment history is very important as far as our credit is concerned. The amounts that you owe, that composes about 30% of the credit score. The amounts that you owe, ideally on the revolving accounts that you have, whether it's credit cards, store cards, those types of things, you want to keep the balances below. Ideally, they're zero, but if you can keep them below, 30% of the credit limit is, then you'll be in good shape. If your credit balance, if the balance on your revolving accounts starts to exceed 30%, then it brings down your score because it makes it look like you're overextended. So concentrating on the budget, creating the savings, paying down the debt, paying off the collections, keeping the balances on the revolving accounts below, ideally 30 to 35% is a good idea, because then it won't make it look like you're overextended. And in a perfect world, all those debts will be paid off, and definitely no outstanding collections either. Like the credit history, the longer you have a relationship with one individual creditor, the better to look for your mortgage lender when you're making an application. Again, that mortgage lender wants to set up a long-term relationship with you. And so what are they going to use to determine whether or not they want to enter into that long-term relationship? They're going to take a look at the last 7 years worth of your credit history. And if you've had a relationship with your student loans or auto loans that have been impeccable, you've never missed a payment, they're going to look at that, and that's going to encourage that lender to want to lend you potentially, up to close to $500,000. And so you have to prove it to them. You have to use these credit reports almost as like a report card, in the sense it's like a financial report card that you're using to display the fact that you are worthwhile for a lender to extend that loan to you. So demonstrate that within your payment history and then within the information on the credit report. 10% is a new credit. Try and make sure that when you're applying for different items that involve credit, whether it's credit cards, store cards, personal loans, you want to try and limit the amount of applications that you're making shortly before you're applying for a mortgage. And even when you are applying for a mortgage, try and consolidate the amount of applications that you make, ideally within like a 30-day period. Because if you apply twice in October to a couple lenders and then apply 3 times in November, maybe once in December, what the credit score does is it automatically assumes that you're getting turned down for these loans. You may or may not be, but you want to consolidate all those applications. And if you're being an educated consumer, you're shopping around, which is fine, but just try and make sure that all those applications are consolidated within a 30-day period, so it doesn't ding you with these hard inquiries, which would reduce your score. So new credit is a factor, and then types of credit used. Show diversification. Show diversification within the credit report. Installment loans, auto loans, student loans, and then revolving accounts. To where once you pay it off, then you still have the ability to charge it up again. So diversification within those credit reports, that's very important as far as the score is concerned. All right, that's my spiel on credit. Now we can talk about mortgage payment components. Maria touched on this, but again, kind of 43 to 45% is pretty healthy. That's the total debt to income ratio, back end ratio. You want to make sure that not much more than anywhere between 43 and 45% of your monthly gross income is consumed by your monthly mortgage payment, in addition to all of the consumer debt obligations that you have. Monthly mortgage payments composed of the principal, that's going to bring down the balance that you owe, the interest that you're being charged, dependent upon the credit, and also part of that mortgage payment would be your property tax obligation, That goes to the county to pay for schools, roads, fire department, police department, those types of things. Hazard insurance is going to protect the home against any types of fire, wind damage, etc. Private mortgage insurance. If you are coming in to the purchase and you have less than 20% worth of a down payment, a lender wants you to take out an insurance policy to protect that lender in the event of a foreclosure and then the property sells for less than what you owe. So there's a requirement for an insurance policy that you'll have to pay for to protect the lender if you come in with less than 20% down. There's a couple ways to do this. Either you can make a monthly mortgage insurance premium that you would just add to your monthly mortgage payment, or if your credit is good enough, you can technically finance that private mortgage insurance. And so if you were to qualify for, let's just say on the surface, for a 30-year fixed rate mortgage for 3.25%, you have the option of either paying that monthly mortgage insurance premium on top of your mortgage payment, or you can potentially increase that interest rate from a 3.25 by about 50 basis points, maybe to 3.75. And then technically you're financing the private mortgage insurance over a period of time. You can't get around the PMI. Again, if you're coming in with less than 20% down, a lender wants to make sure that they're more comfortable, so they're going to require that insurance policy. And as soon as you reach the threshold where you have 20% equity in the property after you move in, at that point in time, you can communicate with your lender saying, hey, guess what? Take a look at my balance on mortgage, take a look at the value of the property, and then recognize that I have 80% equity in the property. At that point, I have 20% equity in the property. As soon as you get 20% equity in the property, you can communicate with your lender and drop that private mortgage insurance. That's good to know. And lastly, homeowner association dues. Oftentimes, people are moving into communities, whether it's a condominium or a planned unit development. If there's shared amenities or common area, then you're going to see that there's homeowner association dues. I would say these range anywhere between like $200 at the very minimum, maybe even up to like, I've seen HOA dues of up to $700, and then they're doing your laundry and walking your dog. But at the same time, it's an obligation that you'll be made aware of before you move into any type of community where there's a homeowner association. So factor that in. That will be a part of that total mortgage payment that's used to determine whether or not you're exceeding that 43 to 45%. Okay. That being said, it's a lot of numbers, but you got to know the numbers before you can identify the mortgage that you can qualify for in order to determine if you're in a good position to purchase a home. So that's important. All right. So on to our program, Santa Barbara Inclusionary Housing Program. We live within Chapter 46 of the County Code. Ultimately, anytime that there is a residential development of more than five or more units, then that developer is required to allocate a certain percentage of that development as affordable. That could be either rented to households that earn a percentage of the area median income, or they can be sold. And so once those units are produced, they become a part of the county's inclusionary housing program. And then we make them available to members of the workforce so that you guys can go ahead and take advantage of opportunities to live close to where you work. Because again, our goal is to retain the fabric of the community. We don't want to have a drain of all the talent from local employers. We want to make sure that people have the opportunity to live and raise families, et cetera, close to where they work. It just creates a better community altogether. So our program under Chapter 46, we have similar requirements to the city, but they're not exactly the same. We do not allow for residential ownership by an applicant for 3 years prior to making an application. Whereas the city, they just want to make sure that you don't own anything at the time of the application once you do purchase a new unit. We require that you have not owned anything for 3 years prior to making an application with us. So that's one delineation. We make sure that the household that is applying for the unit has been established for 6 months. So if there's a 2-bedroom unit, we're going to require that there's a household of at least 2 people that qualify for that purchase. And those 2 people must have been living together for 6 months prior to making the application. Sometimes we want to avoid the fabrication of a household. So for instance, We want to make sure that somebody who's applying for a 2-bedroom house, if they're only in fact a 1-person household, they can't just call up grandma who lives down in Los Angeles and have them move up with them, in theory, to qualify for the purchase. And so we make sure that the household's been established for 6 months prior. The applicants must live or work within the county. The unit must be the primary residence of the applicant once they move in. There's a requirement. We require at least 3% down unless they're qualifying for a VA loan. And then they must agree to abide and sign the resale restrictive covenant. The covenant for the county, it's the evidence of a homeowner's promise to live under the guidelines of the county's inclusionary program. So indeed, we're requiring that the owner promise us that they're going to live there as their primary residence. They're not going to rent the unit out. If they do sell or refinance within the term of the covenant, then the county will set that maximum resale value. We want to make sure that we're keeping the affordability of these units intact. And so there's a requirement for any owner to sign a covenant with the county that's recorded on title to the property, letting everybody know that everybody's aware, the owner's aware of the obligations to live under the guidelines of our program. We have income and asset restrictions. We want to make sure the income restrictions, it's the percentage of the area median income. If and when you guys do have the opportunity to visit table number 30 at the housing fair, then you can pick up, it's an interest list sign-up form, and that's going to spell out all of the income limits for households that can qualify for our program. But ultimately, we want to make sure that you can't earn, as a household of 2, for instance, you're not going to be earning over $150,000 in order to qualify for a unit within our program. So we make sure that there's income restrictions, asset restrictions. We want to make sure that people don't have all sorts of money set aside in non-retirement accounts in order to qualify. We require a FICO score of at least 620, if not higher. And then we have a maximum debt to income ratio of 45%. Okay, so all that being said, you've taken a look at your budget. You've taken a look at these credit reports. There's no errors or inaccurate information on there. So your budget's good. You got a positive cash flow. You've been contributing toward funds that you can use for a down payment. You may have communicated with one of these local organizations to help with the down payment, either the Housing Trust Fund or California Housing Finance Association. And you're ready to move forward and I guess sign up with the county. So we would have you complete an interest list sign up form. And again, these forms, they're available at table 30 at the housing fair. Go pick one up. And then by completing the information on that form, you would submit it to the county. You can do it electronically or drop it off at our office. We will include your household and your information within our database. And so anytime that one of our units becomes available for resale, we will reach out to households that are already on our interest list and make them aware of the opportunity. Again, it's about being prepared for the opportunity that arises. So at least put your hat in the ring, right? And I always encourage people to, like Maria said, communicate with more than one jurisdiction. Don't just put your interest list in for the county. Also put it in for the city of Santa Barbara, city of Goleta, city of Carpinteria. So you have a few different pots on the fire because that's going to increase the opportunities that become available to you when you are prepared. So get that interest list form. It's available at table 30. And then gather necessary documents for the county application. The county application is very thorough, and our process is probably more thorough than the lender that you're working with would require. It's similar, but we're very thorough. So for instance, if you are a W-2 employee, then we're going to want 6 months worth of your pay stubs. So start gathering that information together, put it in a file, have it available to you so you can submit it to us if and when the opportunity arises so we can confirm your eligibility. Take a look at putting aside 6 months worth of your bank statements. And these are all accounts, checking, savings, money market, CDs, etc. We want to take a look at the assets, make sure we can take a look at the funds that are coming in and out. Make sure when you are preparing to apply for a mortgage or for a housing program through one of these local jurisdictions, you want to be as plain as possible. Try not to have too many curveballs or surprises within the activity that's reflected in those bank statements. If we have people that are, funneling money, maybe to relatives in different countries, that's going to put up a red flag, and that's going to lead to further inquiries, not only by the county, but your lender might have an issue with that as well. So you want to be as consistent as possible. Don't make any large purchases. Don't go out and purchase, a brand new vehicle a week before you want to open up escrow to purchase a unit. It just makes it look like you're not ready, or not at the home purchase isn't as much of a priority for you. So within those bank statements, that's going to tell a lot about your spending activity. And again, think of it when you're submitting an application to a lender or for a housing opportunity through one of these programs, you want to prove to the entities that are considering your application that you have established a consistent pattern where you can meet all of your obligations and then not overextend yourself. So that's important. 2 years worth of tax returns, last quarter's worth of retirement account, proof of right to permanently reside in the United States. It could be permanent residency card, it could be a passport, what have you. We do work with DACA recipients as long as you can demonstrate that you're making steps toward getting citizenship. So that's a case-by-case basis. Make sure you get a copy of those credit reports from all three bureaus. And then eventually you're going to look into getting a pre-qualification from your mortgage lender. It's a pre-qualification letter that it doesn't require as much documentation, but the lender will give you an idea by meeting with you preliminarily. They'll give you an idea, okay, looking at your income, looking at your credit, looking at your assets, this is how much you can realistically afford. And so having that letter is important because not only will it show you that maybe you shouldn't be submitting an application to purchase a unit or an offer to purchase a unit of, $750,000 when you can realistically only afford a $400,000 property. So it's really going to help ground you and save you time and kind of identify the available units that you can realistically afford. Your mortgage lender, again, it can be your institutional lender where you have your checking and savings account. It could be a credit union. Whoever it is, we can work with anybody. But make sure that once you do have all these documents in order, then you can start communicating with your lender, provide them with the bank statements, tax returns, et cetera, so they can pay stubs, so they can go ahead and recognize that you're worthwhile as far as the risk is concerned. And then they can give you that pre-qualification letter. Anytime that you even are taking a look at an open house, for instance, the owner of the property or the real estate agent representing that owner, they're going to want to make sure that you're bona fide and that you have the ability to qualify for a mortgage to even allow that purchase in the first place. So make sure that you have the financing squared away before you start realistically looking, because most owners, they definitely will not entertain an offer unless you can demonstrate the ability to obtain financing. And oftentimes a real estate agent won't even make the unit available to show to you unless you can, again, show them that you can qualify for a mortgage to allow that particular purchase price. Okay. So we have the pre-qualification letter from your mortgage lender. It's usually good for anywhere between 60 to 90 days. You can always get it renewed. But once you have that, it's almost like a golden ticket in a way, because that just will open up the opportunity for you to start making offers on places because you can demonstrate the proof of funds that you can qualify for that mortgage. Okay, so once you have submitted an offer, you have the proof of financing, your offer will be submitted with that proof of financing. And then if your offer is accepted, then that's communicated to you, and then you would start the purchase process. So it opens up escrow. Escrow is a 45-day period within which certain conditions will need to be met by a few different parties. The lender would require certain conditions are met. The buyer is going to require that certain conditions are met. The seller would definitely require that certain conditions are met in order for this deal to close. And so as a buyer, the one thing that you want to concentrate on once escrow is open and once you're creating a contract to purchase a unit, you're going to want to put in stipulations as far as your offer is concerned. Typically, the buyer always puts in conditions, two major conditions, one of which would be the financing contingency, and the other would be a home inspection contingency. And that means that you're telling the seller within the first maybe 2.5 weeks from when you open up escrow, you're going to want to make sure that you receive information from your lender that's going to spell out what the mortgage terms will be. You want to feel comfortable with the payment, with the interest rate. You're going to make sure you feel comfortable with that financing before you're willing to move forward with the transaction. And you're going to put the time frame probably about 17 days after you open up escrow to sign a waiver releasing that contingency. But that's number one, is the financing contingency, because you can work with a lender who gives you a pre-qualification letter saying that your monthly mortgage payment is going to be $2,000. And then once they eventually, it rarely happens, but it's possible that a lender can come back once they provide you with what they call as a loan estimate. Then they may come back and say, oh, it turns out your housing payment is going to be $3,000. And if they, oh, hold the phones, I know that can't fit within my budget. So therefore, if that payment, if I'm not comfortable with that payment, then I can go ahead and use that financing contingency to back out of the deal, as long as I do so within that first 17 days. So the financing contingency is number one, and it's very important. Number two, you want to place a home inspection contingency as well. And this is not required, but highly recommended. And what that home inspection will do is you would communicate and contract with a home inspector who will come to the home that you're looking to purchase, and they'll give an inspection, and they'll let you know if there's issues with the windows cracked, or the foundation is a problem, or the roof's falling apart. And so you want to make sure that you can place that home inspection contingency, let a seller know that you would be willing to waive that contingency after 17 days. So again, this first 2.5 week period is kind of a free look at the property. And then if the home inspection, once you contract with someone to go take a look at the property, if that report comes back to you and you recognize that there's $25,000 worth of termite damage that you weren't aware of beforehand, then you say, okay, I've got that homeowner inspection contingency. So that's going to allow me to back out of the deal, because now this is new information coming to the table. So again, it's an opportunity for a buyer to protect themselves. And those are the two best ways to do so, and allow yourself to back out of the deal and not be expected to move forward move forward with the transaction if you're not comfortable with those two items being accomplished. So again, financing contingency and then home inspection contingency, those are imperative. And then otherwise, our program, a lot of times the resales are done through either for sale by owner transactions, or they're done so through a real estate. It doesn't make a difference to us. We can work with them in any way, shape, or form. But make sure you remember that as far as when you do open up escrow, place those two contingencies in there just to protect yourself, and then make sure that they're accomplished within about 17 days from when you open escrow. Okay. So action steps. So here we are. Item number one, pre-purchase education. Educate yourself as much as possible. There's lots of free information that's available to you to educate yourself on the process. You want to make sure that you're comfortable with your finances. You want to make sure that you're comfortable with the process that you're going to be going through. So there's plenty of opportunities to educate yourself and feel confident, because again, this is one of the largest financial obligations that you're going to commit yourself to. So you want to feel comfortable with your making that type of investment, financially and then emotionally as well. Start gathering all the necessary application documents. Start gathering those documents required to apply for a mortgage. I'm not sure if anybody that's listening would be, or potentially is self-employed. The self-employment documentation is a little bit different than a W-2 employee documentation. Self-employed or entrepreneurs, they'll be required to put together about 12 months worth of bank statements for their lender. They'll have to put together the last 2 years for the tax returns, including all schedules, specifically Schedule C, and then a year-to-date profit and loss statement for the business, so that a lender can use that and recognize, typically within the bank statements, within the tax returns, and then within the profit and loss statement, a lender and the county, for instance, could recognize how much income you're earning. So for self-employed individuals, I'll repeat that, 2 years tax returns, all schedules, 12 months bank statements, and a year-to-date profit and loss statement. They'll also take a look at credit reports and all the other things as well, but that's the one unique aspect for entrepreneurs. All right, and then obtaining credit reports, get those. If you haven't received copies or you haven't obtained copies this year, get copies. You're entitled to get them for free once every 12 months. Get them from all 3 credit bureaus because the information is different. Again, they're all repositories. They're just gathering information that's reported to them from the different creditors that you have relationships with. They may even gather information and report information on your credit report from creditors that you do not have relationships with. And that's where those errors come into place. If you have a common last name, it happens all the time. If you're a junior or a senior, it happens all the time. So take a look at these credit reports well in advance to make sure there's no inaccurate information or outdated information, because you don't want that to hold up your application process. You might lose out on getting a competitive interest rate because of the amount of time it takes to rectify those errors and mistakes. Increase your saving for down payment and closing costs. Take a look at that budget. Find out whether or not you have that positive cash flow or negative cash flow. If you're a positive cash flow, fantastic. Start allocating that toward a designated account that you can use for the down payment and closing costs. And then contact your lender for a pre-qualification. Once you have all those documents together, whether you're a W-2 employee or entrepreneur, once you have all those documents, that's when you can communicate with your lender and get that general sense of how much you can qualify for in order to make that purchase. You don't want to deceive yourself thinking that you can qualify for something that's much more expensive than you can. So getting an idea about that pre-qualification, it's going to help you narrow down the search and help you use your time most efficiently when you're trying to find purchase opportunities. This is my contact information. We're over at the 123 East Anapamu Street. Our offices are open from Monday to Friday. You can always contact me via email, by the phone, and then I can help guide you through the county's process, and I can answer any questions that you guys have. We've also included some website resources. Here's the county's website right here, annual credit reports. Get a copy of those as soon as you can. Homeownership education, you can go through the Fannie Mae website. They have a lot of really good, useful tools available to people preparing for homeownership. Multiple listing service. This is the MLS. This is what is it? It's a database full of properties that have sold and that are currently listed for sale. So, usually you would need a relationship with an agent, a real estate agent, to get access to this. But again, before you establish that relationship with a real estate agent, you got to get that pre-approval letter, a pre-qualification letter, so you can demonstrate how much you can qualify for and narrow down the search. A couple of important programs for assistance with your down payment, either through the California Housing Finance Association. They have down payment assistance programs. And then also locally, the Santa Barbara County Housing Trust Fund has their own down payment assistance program. Again, that's, I think, between the credit and then the down payment, that's going to be the largest hurdle to put yourself in a position to qualify. The down payment is just a matter of saving up the money. So it's hard to save up anywhere between $15,000 to $25,000 on a purchase. So take a look at these two resources, because if you earn a particular amount of income, or if you have a certain type of employment, then there are designated programs available to you that can help you come up with that 3% down, or even more for that matter. So you can put your foot in the door of qualifying for a home purchase. I think that was about it. We're both definitely available for questions, but thanks for attending. This is a lot of useful information. I know we're just scratching the surface here. There's a lot of steps that are involved with the process, but you do have the resources available to you between Maria, myself, between the City Housing Authority. We're here to educate you on preparing for that process. And so any questions that you have, certainly feel free to reach out to us. You can discuss them now, or again, you can contact us anytime. We'll be more than happy to communicate. So, thanks for attending.
All right. Thank you, Andrew and Maria. Great presentation. We know that there's the American dream of homeownership. It builds wealth, it builds security, and that should be available to everyone, not just the wealthy. And these two essential programs, one through the city and one through the county, offer that ability for everyone to be able to enjoy that homeownership opportunity. So it's really good to take advantage of those programs. And Maria, Andrew, thank you so much for giving up of your Saturday to present today. I really appreciate it.
You're very welcome.
Thank you.
Our pleasure.
Okay.